In this video, we will explore the terminology used in the commodity market. While trading stocks is often about digital numbers, the commodity market deals with physical goods, which brings its own unique set of terms and concepts that you need to master. Let us start with the most fundamental concept, the spot price. This is simply the current market price you would pay if you wanted to buy a commodity and have it delivered immediately. Just like in any other market, this price is determined strictly by the forces of supply and demand. If many people want to buy wheat today, the spot price goes up. This price is not just for immediate trades. It is the anchor for the entire derivatives market. Commodity exchanges track this spot price every single day because it forms the basis for futures contracts. They also use it to calculate the final settlement price, or FSP. This FSP is crucial because if a futures contract is settled in cash or if a seller defaults on their delivery obligation, this price determines how much money changes hands. Now that we have the spot price and the futures price, we can look at the relationship between them, which is called the basis. You can calculate this using a simple formula. Basis equals to spot price minus futures price. It is essentially a measure of the difference between what an asset costs right now versus what it will cost at a future date. Watching the basis helps you understand the strength and direction of the relationship between the spot market and the futures market. When we compare these two prices, we often see a situation called Contango. This happens when the futures price is greater than the spot price. If you were to look at a graph, the price curve would slope upwards over time. This upward slope tells us about market sentiment. It means that market participants expect the spot price to go up in the near future. Because they expect prices to rise, they are willing to pay a premium today to lock in a purchase for a later date. The opposite of Contango is a situation called backwardation. Here, the futures price is less than the spot price. On a graph, you would see the price curve sloping downwards. This indicates a very different market sentiment. In this case, participants expect the spot price to come down in the near future. Perhaps there is a shortage right now driving up the current spot price, but everyone expects supply to normalize later, making the future price cheaper. A major reason why futures prices differ from spot prices is the cost of carry. Since commodities are physical goods, holding them costs money. The cost of carry is the total expense involved in holding a commodity from the date you buy it in the spot market until the date you deliver it for a futures contract. This is not just one cost, it is a bundle of expenses. You have storage costs because you need a warehouse to keep the goods. You have to pay for insurance to protect against theft or damage. You have transportation costs to move the goods. And finally, you have financing costs, which is the interest you pay on the money you borrowed to buy the commodity in the first place. Let us look at a practical example to see how this works mathematically. We'll calculate the fair value of a futures contract. Imagine we are dealing with 10 grams of gold. The current spot price is 1,02,000 rupees. The cost of carry is 8% per annum, and we are looking at a duration of 3 months. To find the fair value, or F, we use the formula where F equals to the spot price plus the cost of carry. The cost of carry is calculated as spot price multiplied by the rate multiplied by the time period in years. So, in our calculation, F equals to 1,02,000 plus the interest cost. The interest cost is 1,02,000 multiplied by 0.08 multiplied by 3 divided by 12. When we do the math, 3 divided by 12 is 0.25. So the interest part works out to be 2,040 rupees. Therefore, F equals to 1,02,000 plus 2,040. This gives us a final result where the fair value equals to 1,04,040 rupees. Finally, we must understand the concept of delivery. This is the biggest difference between the stock market and the commodity market. Financial instruments like stocks are intangible. They are transacted in Demat form, meaning they are just digital entries that change hands. Commodities are different. While you can trade them digitally, the contracts are often deliverable. This means that upon the expiry of the futures contract, the trade is settled through the physical delivery of the actual goods. The seller must hand over the gold, grain, or oil to the buyer, making the logistics we discussed earlier very important.